Hi everyone, my name is David Kosmeter. I'm the creator of Timing Research, and this is our show for February 17th, 2015. Today we will be discussing the 73rd weekly report from Timing Research, and this week Dave Landry, my usual guest host, is in Italy. So Cameron Yost of DimensionTrader.com, who's been on the show before, will be taking over as the guest host. So I'm going to go ahead and turn that over to him now.
Right. Hey, thanks, David. My name is Cameron Yost. I'm with Dimension Trader. We have futures trading software, quite a palette of indicators. But I'm a futures trader as well as a options trader, and honored to be here today, David. Thank you for inviting me to be a guest host. I know the other David sitting in Italy, I guess, enjoying his time in Rome. It'd be a great place to be right now. Well, let's get started. We've got our guests today. We'll start with Todd. Why don't you introduce yourself? Tell us a little bit about what you do, and then Stephen and John after that.
Sure. Thanks, Cameron, for hosting, stepping in, and thanks, Dave, as always, for having me on the show. I enjoy it. So I'm Todd Gordon. I run TimingResearch.com. I have been on CNBC quite a bit. Work with them as a full-time contributor, and I'm on usually about once or twice a week. And my business, we focus on technical analysis of kind of the macro markets. So we'll trade the four major asset classes: stocks, bonds, commodities, currencies. And we'll take a little bit more advanced, I'd say, look. We focus on Elliott, Fib, intermarket analysis, pattern recognition. Obviously, overlay it with what's going on in the fundamental world. Sometimes there's a difference between what people are thinking is happening is actually happening. So we'll try to find those patterns. And you'll have to forgive me. I'm definitely sick. I hosted my kids' first birthday, twin boys. We had about 80 people in the house. 40 kids, and I'm definitely sick from it, so I'll have to struggle through it. So thanks again, guys. Enjoying, looking forward to being on the show.
I remember those days. You'll get well soon, though, I'm sure.
When they move out.
That's right. Todd's website is tradinganalysis.com. Stephen, how about you? Tell us a little bit about yourself.
All right, sure. Thanks for having me. My name is Stephen Place. I am the founder and head trader at investingwithoptions.com, where we teach people how to become great option traders. My edge lies through a combination of understanding how options are priced and how that price changes, as well as technical analysis. I believe that it's not just about what the charts are telling us. It's about what people think the charts are telling us, and if you can try and fade those people that are looking for the obvious levels, I think that there's an edge there, and I've been doing a lot of that recently too.
Very interesting. Thanks. John, let's move on to you.
I'm John Nyaradi. John Nyaradi. I publish Wall Street Sector Selector. We specialize in exchange-traded funds, particularly we're focusing on leveraged exchange-traded funds. We do mostly technical analysis. We go long and short. I publish a lot of different places, MarketWatch, USA Today. Used to be on Seeking Alpha for quite some time. So our specialty is looking at macro indicators as well as technical indicators, and then try to go long and short with the strongest sectors using ETFs.
Now, ETFs have become quite popular lately with a lot of traders. Yeah. Well, let's jump right in here to the questions on the Timing Research crowd forecast from this past week. And the first question I'm going to throw out to the three of you, and then we'll start with Todd and just do this round robin again like we did.
Sure.
What developing events, whether it be technical or fundamental, are you going to be watching this week, the week we're in right now, that might have a positive or a negative impact on the S&P 500 or other U.S. markets?
Sure. It's interesting. Everyone seems to be talking about Europe, and I formerly traded for a currency hedge fund, and the shows on Money in Motion on CNBC was focused in currencies, and frankly, I don't think there's a lot going on in currencies right now. As much as everyone's talking about Europe and the Grexit, Greek exit, I'm just not seeing it manifest in price action. European equities are highs. Euro's doing fine. If anything, I think I don't know. I feel like we have a risk-on market here. I'd be curious to know what I believe Steven, if I have that correct, would think about the sector analysis. But we have gold breaking down. We're personally short gold. I booked some profits this morning. Gold breaking down. I think stocks are kind of knocking on the highs. The sector makeup right now I think is incredibly strong. One of the strongest sectors right now is consumer discretionary, which acts well. Materials act well. Healthcare is doing well. The XLK technology ETF is coming up, and we basically track a 1 week, a 1 month, a 3 month, and a 6 month % change in sectors, and the sector makeup right now I think is quite strong. So we're net long. I'd like to be getting all excited about what's going on in Europe, but I'm just not seeing it manifest in price action. So right now I think it's business as usual. Just got to focus on improved U.S. economic data, the Fed liquidity trade coming out, gold dropping, energy stabilizing, which is a good thing. So I think it's business as usual right now.
So you're not concerned about any of the short-term impact that may come with the FOMC minutes or housing starts or unemployment this week?
No, I mean it's the way things are trading. Bonds are coming off. Gold is lower. Stocks are right back at the highs. We tried to sell them down in the open. They're acting pretty well. Bonds lower, maybe. If rates are going to go higher, it seems to be that markets actually are taking this quite well. So it's almost like if the Fed is going to come out and start to zero in on a date in 2015 in which rates will start to go higher. Just reading the tape, I am first and foremost a price action and technical trader, and markets seem to like it. So I'm going to continue to stay long with clients.
There you go. There you go. Thanks, Stephen. How about you? What do you think? What are you watching for this week that may have an impact?
I'm trying my best to tune out all of the noise, and this year has basically been dictated by noise. So I think basically I've got a couple key reference points on the SPX cash, basically right around 2065, 2070. My thesis is the longer we hold above that, the higher the odds that we do continue higher. It's basically a set of conditionals for me. We are breaking out to new all-time highs. We're probably going to grind higher. The other thing I'd like to point people to is the VIX. Basically for the entire year, we've had quote-unquote bad news or the potential for bad news or the next shoe that's about to drop, and investors have been aware of that, and they've been hedging. If we look at the VIX has traded above 15 the entire year. If you look at the VVIX, which shows the demand for VIX options, and if you look at other hedging instruments like VIX futures, they've also remained elevated all year. So everyone's been looking for this next shoe. We've had investors continually buying hedges. And I think we're coming to the point in which a lot of institutions are going to say, you know what, screw it, I'm not going to buy any more protection, and that's going to most likely be led or be coincident with a continued rise in the markets. And once we finally get all of that premium burn off, once people stop buying so much protection, that's when we're going to roll over, but we're not there yet.
Great. All right. John?
I think for the week, the two fundamental things, obviously, the Greece news, as everybody seems to be mentioning, the markets believe that this is going to be settled, and I mean, nobody has a crystal ball. We've been trained and taught that these things do get 11th hour solutions. If that doesn't happen, it's going to be a heck of a surprise for everybody. So that's, I think, the one major event of the week. I think people are underestimating these people in Greece in terms of their resolve to not be under the thumb of Germany and the Troika. So I think there's a 50-50% chance of that going opposite to how the market believes it will. Of course, the FOMC meeting has always been, they've been driving this thing since '09, so we'll see what Miss Dr. Janet has to say this week. So those will be the two major fundamental elements that I'm watching.
Well, we've got a lot of news coming, and I guess we'll just wait and see here what really happens when it comes. Well, let's direct now. Let's go into what your feelings are on how you feel the market's going to move this week. Now, I'll just read the question here right off the forecast newsletter. Based on any technical or fundamental indicators you want to use, would you predict the S&P is going to move higher or lower this week? Todd, let's start with you.
Sure. And let's see. I'm actually just doing a quick little calculation here. As I said, I'm a big fan of Elliott and fib price patterns, symmetry, harmonic patterns, etc. And we're at a key level right now. If you look at the SPX daily, if you go from the December 16th low, about 1972, this is the cash again, swings up to mid-December about 2093. That's about 121 points. Fast forward to the February 2nd low, we'll call that the Groundhog's Day low. Another 121 point swing puts us at 2102. We're right now at 2098. So we're 3 S&P points away from breaking, we're 3 S&P points away from testing symmetry. This is the last ditch bearish technical argument I could make. If we hold 2102, and again, we're at 2099 right now, start to move lower, okay, symmetry will have held. If not, my alternate trade scenario has been scrapped, and we are, as I said, long the stock market, and I'm looking for 2150 in the S&P, 2155. So if we break in the next 2 to 3 points, I think we go higher, and then 2150. We'll have 50 points to play with, but I think there's major questions that need to be answered up there. From an Elliott and a fib and a harmonic pattern point of view, I think there's major resistance up there, but we'll take it 50 points at a time.
So if we see the break at 2102, do you think we'll be at that 2150 by week's end? Do you have any idea of how quick it's going to get
and
there?
I know we have Fed in here. You could just drop it anywhere, thanks. It's a shortened week. I'm going to say, how about yes? How about yes? I'm long, but 2150 by a week's end, that's going to be a pretty ferocious rally with the Fed in there. I'll go with yes. Why not?
All right, man. All right, Todd, thanks. Stephen, how about you? What technical or fundamental indicators, using whatever, are you going to predict the S&P is going to move higher or lower this week?
Sure. So one of the things I like to look at is a Bollinger Band envelope. And I'm going to see if I can, just visualize it. Bollinger Bands are an adaptive volatility envelope, and they show us when volatility has been compressing and expanding. Basically for the entire year, basically since November, we've been in a range. The S&P's been in a range. It's been in a volatile range. We've seen a lot of volatility, but we've seen a lot of reversion on top of that. When we see the Bollinger Bands open up, when we see Bollinger Band expansion and the market breaks out, the market tends to trade between the first and second standard deviation upper Bollinger Bands. Okay, and it just kind of rides it, and it's what I would call a grind, where if you look at market rallies when we've seen extreme selling, when we've seen capitulative movement, those rallies tend to be the largest. When we see breakouts to new all-time highs, it tends not to be a vicious rally. It tends to be a grind higher. So, I expect a correction here, but I expect that correction to be momentum-based rather than price-based. We will stop moving as high as fast, and we'll just start to grind higher. So, bullish events notwithstanding, I don't think 2150 is a reasonable target going into the end of the year, or end of the week rather. It'd be nice. I just don't think that's going to happen just yet. I wouldn't be surprised if we saw some kind of sideways action to work off a lot of the buying momentum we've seen, and then a second leg higher. So I'm bullish right here until proven otherwise. If we lose 2060, give or take, the bullish thesis that I have is failed, and we've seen a failed breakout.
All right. Well, let's John, put your 2 cents in here. What you're looking at this week?
I would say marginally higher, but we're near the end of this move would be my feeling.
Marginally higher.
But very, very limited upside potential, I think, at this point.
Now, what do you attribute that resistance to here?
Well, we just made new highs, and that was fine. If you look at so many ways this thing is overextended, and the put call ratios, and you just look at almost any technical indicator, as you were talking about the Bollinger Bands, and the symmetry point that Steve was talking about. So I think we're at, even though we just made new highs, this looks to me like it's just sort of a topping area here, and I would say the next significant move is going to be lower. Now, when that happens, I don't know if it's this week. I would say marginally higher for this week, but very low risk reward. So I'm in cash for the week. That's where I'm sitting today.
You're just going to stay in cash, so you're not gonna position yourself for any type of correction at this.
No, I'm just waiting to see what happens next year until I get a signal on the downside. But I'd say it's closer than significantly higher prices.
Cameron, do you mind if I follow up with John on a question there?
I want you to. Thanks, Todd.
Oh yeah, of course. And John, I incorrectly referred to you earlier about interesting on the stock selector. Are you tracking the makeup of the sector leadership on the top side? Is there anything in there specifically that I might be missing that's bearish that's causing you to do that? I was very curious to get your take on that.
No, I agree with you on the sector. Certainly, again, they're vastly overbought, I think, across the board. If you look at a bunch of different indicators of your fib levels, and you mentioned, and so of course, I've been a closet bear for some time here. I just have to go with what you see, not what you think.
Yeah.
Because a lot of this looks to me like smoke and mirrors. It has been, maybe will continue to be, but certainly the rebound in oil and energy, as you said, is strong. And tech is fine. But it's just looking at the things I look at technically, like this is near the end of this push.
Interesting. I was just wondering what you think. I mean, I just watching this XLY consumer discretionary in the last 2 weeks just come screaming back. All of a sudden, we're leading with those discussions. I mean, it looks like the consumer is back. Yeah. I mean, housing, ITB's breaking out, housing's breaking out, even with interest rates going higher. I mean, trust me, I'm right with you. I mean, this is such a Fed manipulated rally, but I'm smart enough to know I'm not smart enough to pick the top of this move.
Oh no, I'm not. Nobody is. I mean, none of us have a crystal ball, and that's what makes it so interesting. I'd like to say just about this timing research idea here. You have 4 different guys and 4 different opinions. It's a fascinating world we're in, and I think this crowdsourcing idea is valid. I mean, I've read a couple studies on crowdsourcing as an idea. I think it's a valid point. I think you can get a blend of the wisdom of the masses here, and that's what's moving the markets in the end. It's not you and me or what we think.
Absolutely.
Well, great. I tell you what, it's hard to stand in front of the bull, as they say. But John, I agree with you. I think we're overbought. I can't believe the bull continues to move ahead. There's a lot of cautionary comments out there we're hearing, but like you say, you're a closet bear. Some of the bears, are just screaming a little louder right now. But the bull keeps moving forward. It's just amazing. It is just amazing. Doesn't make any sense. Well, so
and that comes back to what everybody's saying here. You have to be in a bubble and look at your charts, and whatever you do, believe in that, and that's what you have to do. No matter what you think, you've got to trade what you see, and I think that's the hardest thing to do for people. One of the hardest things is that. Second hardest thing is sticking to your plan, which we were going to get to later in your question. So,
there we go. It is. I mean, it's hard to. A lot of people trade their emotion, and that'll get you the first thing that's going to get you in trouble. There's no question about it. Well, on the crowdsourcing, the numbers that came back, we had 53% of the respondents thought that the S&P 500 will move higher this week. So that's not real strong. I mean, it's just a little over, the majority, a little over half. All right, let's go back around and let's talk about the confidence level you have in your your answers about if you thought that it's going to move higher. I know, Todd, you were saying if the SPX closes above, if it does have to close above 2102, or just
yeah, I'd love to see a daily bar close north of 2102.
What's your confidence level that?
Again, should we get the 2102 close, which I do think we have, I'll give it I'm pretty confident here that we're going to trade 2150. Whether we get it by the end of the week, I don't know. If you would give me, let's say 7 trading days, a week and a half on the calendar, I would have a 75% confidence that maybe a 7.5 out of 10 that we would trade 2150 inside of 5 to 7 trading days.
Okay, 5 to 7 days. Well,
Yep.
what's your on 1 to 10, your confidence level that we will move higher this week without any qualification? What would that be on 1 to 10?
Yeah, I'll go. I like the average. I hate being average, but the average for the responses is 6.438. So, I'll go 6.18 on my confidence level that we move higher.
You're really going to use a Fibonacci level as your confidence level?
Hey, brother, I get up at 6:18 in the morning. I generally find that 61% of the people believe in Fibonacci, 38% don't. And I'm fresh out of Fib jokes at this point.
It's just spiraling out of control, right?
Who was Fibonacci anyway? Who was that guy? You know?
Which he actually didn't even invent the ratios, but yeah, no, it always gets a chuckle out of people. So yeah, no, I feel pretty confident. We'll go with I'll make it around 6.5, just above the average that we go higher. I do think we are in a good uptrend here.
That's good enough. That's good enough. I think it wasn't a God that created the numbers, and it was just man that discovered them.
We just discovered them, exactly.
Yeah.
Nobody invented them. They're existing in nature.
That's right. Steven.
Right. So basically, if you wanted to be bearish, and if you wanted to see bearish action, the markets had their chance. The S&P tested 2,000, 6 times? I threatened to break down 5 of those times, and we failed to break down. We couldn't find any momentum to the downside. I think, again, one of those reasons is that way too many people were overhedged, overprotected, and underinvested in this market. And now, we've been in a range since November. It's a 3-month range, and we're breaking out of this range, so odds are we will see extension. That's a measurement, of the height of the range. So, right around 1980 to 2080, that's a 100-point movement to the upside. Now, is that going to happen in a week? No. In 3 months? Maybe. Right? So, the psychology's there, and the clients that I talk to in the chat room I'm in, it's the skepticism-fueled rally yet again. I don't think we're overbought by a lot of technical indicators. RSI is not overbought. Bollinger Bands aren't overbought. Any kind of stochastic, if we get a further stretch to the upside, if we see an increase in momentum, then we would be parabolic and overbought. But we're not there yet. I do think we will close higher relative to last week's close at the end of this week. Okay, so probably above 2,100. My confidence interval there is 7. Way too many people, in my opinion, are looking for reversion here. Way too many people here are looking for the same kind of character in the market that we've had all year. But if you look at other asset classes, the change in character's already happened. Oil stopped sucking as much. Earnings season's out of the way. Dollar-yen cross is starting to resume its trend again. The VIX is finally coming back to sub 15. All of those macro characteristics that persisted for the entire year are going away. So it doesn't make sense for the same kind of character in this market, the reversion that we've been seeing, to continue either. I expect trend right now. We're probably moving to a trending cycle.
All right, so you're giving your confidence level is a 7 that the market is going to close higher come Friday afternoon.
Well, is this like The Price is Right? Can I do like a 0.619 or something? Or
It can be.
Oh boy.
John?
I would say, as I mentioned earlier, marginally higher, but I'm not betting on it. So as far as a number, 3 or 4.
Okay, so you have that's below That's below the 50% mark. So you are not very confident that we may close higher come Friday.
Yeah, and I'm not long, so my money's where my mouth is, I guess.
Well, that's what you said. You're in cash. You're just standing by here, waiting.
Let me push back you guys on one thing in terms of this market being overbought in all indicators. What about small caps? Anybody looked at a Russell 2000 chart on the weekly? You know, we are testing this 1220 level in the small caps that was established back in February 2014. We've tried once, twice, three. This is the fourth test of this. I mean, you don't think in small caps when this thing breaks 1200, we're not going to be 1500 bid in the small caps and I don't know, in a quarter. I mean, there's so much built up energy in the small cap, especially in a stronger dollar environment. I mean, I don't know how you say we're overbought. I mean, I think this. I trust me, this thing is built on a house of cards, but the structure of this market is so strong. I mean, I think we're going significantly higher over the next year, and I hate to say it, but again, you trade what you see, not what you think.
Well, the house of cards argument's been here since 2010.
Exactly.
You know, I can't. It's not a falsifiable thesis. You know, if you're doing technical analysis, you need to say, where am I wrong? And you can push the house of cards thesis, you know, for years and still feel right, but, you know, it's not there and it's not really actionable. It's not good risk management.
Hey, if the Fed can maneuver and the Fed can develop an exit plan without disrupting interest rates too severely and in too short of a time period, we could escape this thing. I mean, everyone who's calling this bond bubble, I mean, bonds have been an uptrend for 30 years. You know, who's going to top tick the top of a 30-year rally in the 30-year bond, which has been in place since 1970, whatever, 8.
I've tried a couple times.
Yeah, me too, and I got a few holes in me. So, you know, maybe the Fed can put this thing together. And I mean, I have charts. I mean, I do longer-term analysis. I mean, I see the NASDAQ, the NDX at like 10,000 in the next 8 to 10 years. I mean, this is just cold, hard Elliott wave analysis, and think of it what you will, but I see the markets going significantly higher. And just being a trend-following idiot, as Dave Landry would say.
Yeah. And, you know, it's time frame, too. So, you know, you can talk central banks, but, you know, are you running $1 billion and you have to care about the central banks? Like, my time frame's a month. Like, it doesn't matter that much for me, really. You know, I'm putting on income trades and credit spread sales and long calls and stuff, and I got to be out of those quickly. So, you know, one of the advantages of being not running $1 billion is you have liquidity. You know, you can bail if things go bad. So,
and that's the great thing of being a retail trader, as we all are. I mean, formerly I was an institutional trader. Formerly, you know, now we're all retail guys. I mean, one of my best trades is I'm taking half off gold. I think gold was going to $1,000 and below $1,000 an ounce. I mean, we took a shot at it when gold down got like 1150, 1130 low. We went back up to 1280, 1300, and now I think we're going back down towards 1,000. I think if you want to be out, I think that gold lower trade is a nice second derivative trade of a higher stock play as the dollar continues to move. I mean, once gold gets down to 1,000, that's going to be a wild trade. So I think that's one of the best trades right now.
Well, there you heard it, folks.
Sorry, I'll get back on topic.
Stephen, any comment? Follow up here to what Todd was saying?
You know, I mean, that was pretty much it. I'm looking at, I think gold. I think gold to the short side is a decent play. I think it's extended over the past 3 days. I would prefer a rip to sell call spreads into. So, you know, that's all I got with respect to that. You know, and the whole central bank thing and the house of cards thing. I say that to myself because I have to decondition myself from it. You know, the whole narrative is fun to talk about and it's great for cocktail parties, but you know, it's difficult to put money on the line with that kind of thesis. You know, the consistently skeptical rally, we've seen that game before, and I think that game is about to come back into play yet again, where way too many people are underinvested, overhedged, overprotected, and they've been that way for too long. And once everyone says, screw it, I'm in, I'm not going to buy any more protection, that's when we're going to roll over, but we're not there yet.
John, any comments on what you just heard?
Yeah, I would agree with that last statement that I think we're closer to that point than maybe our colleagues think. But these things always seem to end with blow-offs. Longer run, though, I'm bullish on America. I'm bullish longer run. If you go way out, I think it's going to be a great time. I think we have a few tough years ahead. And then I think in the very long run, it's going to be a very bullish time as productivity, the baby boomers start dying out, wealth gets transferred to a younger generation. But that's way out in the future. That's the billion-dollar guy, like we're saying here, a few day guys. So in the few days, I'm not so bullish.
Yeah, understand. Hey, well, if I may, I'm going to throw in a kind of a bonus question here this afternoon, and it's what's on everybody's mind, and that's the CL or the crude. The big question is it going to go down and test those bottoms again, or is it consolidating here and going to move up? What do you think is going to happen to crude, and how is that going to impact the overall market? Todd, we'll start with you. Let's just stay with
Sure. For now, what I have crude, and again, going back on my wave theory, I have us in a fourth wave correction. I do think we resolve to the downside. I think, to Steven's kitchen, I don't think it's going to do so on such high implied volatility. I know implied volatility is through the roof right now, towards the upper end of the 52-week range. So I think markets are starting to realize that we're escaping any default deflationary forces of oil. I do think we continue to move down, but I think it's going to be within the context of a falling commodity complex within a strengthening dollar environment. So yeah, I do think we get down to the 30s, but again, not in such a panic high vol situation like we saw. One point, interesting point to note on the crude oil market. Again, I do a lot of kind of the timing and symmetry stuff. And I mentioned this on CNBC, and they didn't know what to think about it, and they were kind of looking at me like I was crazy, which you may too, but I doubt it. The decline in the credit crisis collapse in oil, which started in like June, July of 2008 down to the low in March 2009 was 31 weeks. If you then go from the high in oil from June 2014, the most recent collapse, a 31-week decline pointed us to the exact low at the first week of Feb. So as volatile, as insane as the drop was in the credit crisis, as well as what we just saw, this massive repricing in oil, it was exactly equal in terms of time elapsed on that. So it's an incredibly orderly market right now, in my opinion. So to Steve's point, and I know he likes to sell premium, I'd be interested in selling some call credit spreads higher in USO, or maybe even just be short some calls to collect a little bit of premium and vol collapse on the way down. Curious to know what you think.
Stephen?
Sure. So we talk a lot in options land about the VIX, and the VIX measures the implied volatility. It measures the demand for hedging in S&P, in the S&P 500. There is an equivalent volatility index called the OVX, and that measures the implied volatility in USO, which is an oil exchange traded fund. Now the OVX has run, the VIX for oil has run from 15 back in September all the way up to 56. And volatility readings are on an annualized basis. So that means, back in August, the markets were anticipating, around a 15% move up or down within the course of a year. Now it's anticipating a 56% move. Now, that may seem high, right? That may seem really, really high. But if you actually look at USO, the actual volatility in USO and crude oil has been around 58%. What I think will happen here, first off, if you want to go into Fibonacci land, if you look at the move from 2008, and if we had the equivalent move from the highs in 2011, we would be in negative numbers, so it doesn't exist. But the 61.8% extension off of that we hit just recently, so actually there was some magical Fibonacci support right there, right? I'm expecting oil to, it can trade lower, but I expect it to be dead money for a while. I expect a lack of momentum both to the upside and downside. I think if we head back in, for USO specifically, if we head back into the 17s, you want to sell some puts. If we rip up to 23, you want to sell some calls. I could even argue for some strangle sales in USO options with a 3-month time frame. We're probably we may not be done with this downtrend, but the trendiness, the momentum of this downtrend is probably going to start waning a little bit. And that's going to be great for option sellers because the actual volatility will go lower, but the implied volatility in the USO options market is still going to be very rich. So it's going to be a good sale bidirectionally, both to the upside and downside, I think.
Good stuff. John, I know you got an opinion on this.
Well, I think oil, fundamentally, you talk about the game of chicken between Greece and Europe. This is a game of chicken between Saudi and the shale oil producers. Nobody can survive at $20 oil. Even the Saudis, they need in the 70s or 80s to fund their government programs. If this isn't the bottom, it's probably close to the bottom. And in a longer-term world, this is Warren Buffett land in terms of value investing. I think if you look at out to the next 20 years for demand figures in China and India particularly.
Yep. Good. Well, we're at that point here in the program, I believe. We'll just go for closing statements and tell our listening audience a little bit about.
There's actually question 4. I don't think
question
you
4.
talked about that yet.
My mistake, David. Thanks for jumping in there, buddy.
No problem.
All right. One last question. Then we'll go around with closing statements. Have you had the most success with fully automated trading systems or trading systems that are partially discretionary? The fully automated or partially discretionary trading systems? Todd, what's your experience with that?
I've had all my success. I've never been purely mechanical, but I do have a mechanical aspect. And basically what we do at my company is we determine an area or a zone based on fib price, time, wave structure in which we'd be interested in selling the market. And only after we enter that market do we turn the systems on to then go scan for setups. It's all automated risk reward, which is a component of our trading. It's not the only thing I do, but we do have a good degree of success trading an automated system within a predefined zone. Once we exit that zone, then the system automatically turns off and we're out of the market. So it really ensures that you're only trading at premium reversal prices, both support and resistance. So it's a combination of both for me.
All right, good. Stephen, how about you?
I've continued to make the transition away from purely discretionary, just straight up chart reading, to much more systems-based thinking. Here's a cool trick in options land, if anyone's interested. One of the Greeks is called the delta of an option. It measures the directional exposure. It's also, I'm going to bore the crap out of people really quick, it's also related to the odds that that particular option will expire in the money in expiration. The only way to be consistent across different asset classes is to trade versus the delta. So if you're looking at put spread sales, if you want to be consistent, you want to always short the 30 delta put spread. This is important because if you're trading Baidu, that's going to have different volatilities versus trading Walmart. I'm doing some research now with systemizing more of my stuff. I've already done so with my income trading. Things like iron condors and butterflies and calendars, I have a lot more of a systemic approach there. And I'm looking more towards some weekly income stuff and some weekly option selling directional things that I think I've got a pretty good edge on. I just need to flesh it out. It's very difficult with options because it's hard to get good option prices in order to back test stuff. So that's the main issue with the game I'm in with systemizing my things.
Very interesting. John?
I have a set of rules that I follow, but they're not automated. I'd like to do that, I guess, one of these days. If you can take out the human element, maybe you have an advantage there. I mean, you should talk about your system a little bit, Cameron. I watched your webinar the other day. The software they have there trading the futures. I guess in an ideal world, that would be okay. I think the problem I see, potential problem, is that all these things work until they don't. Markets change, and to remove human emotion is a goal, but the markets are driven by emotion, so we're always getting that catch-22 of technical trading and what works until it doesn't. So to answer the question, I'm not automated, but you have to learn how to stick with your rules.
That's right.
I'd like you to talk a little about your system, because I mentioned I watched your webinar the other day.
Well, I appreciate that. But you're right. I mean, there's a set of rules that every trader trades with, and you've got to stay within those parameters. And when you don't, I mean, you're violating your own discipline there, and that's when people get into trouble. You have to trade a plan, and that part of that plan is when you enter and how long do you stay, where are your targets, when do you stop, and we preach a lot of that. We're at Dimension Trader, and as John was mentioning, I'll put my plug in here, then you guys will be able to do closings. But we talk a lot about stopping when you're up, and this is for day traders in the futures markets. And often you can achieve your goals in 1 or 2 trades in the morning, and go play tennis. You know, it could be a nice lifestyle if you've got the mind of a trader. Our indicators are programmed such that we have a system. It's called the Easy Trader that actually colors the bar when you want to go long. And it'll color green. It colors it red if you're going to go short, and it has a suggested that signal entry is where you want to try to get in on a short or long. How you manage is up to you at that point. Now we have 2 automated systems. One of the automated systems is very basic. It just enters you. It gets you in that trade. When the Easy Trader says go long, it's going to get you in there. And we're also using a platform that will then enter your stop and your targets automatically. Just get those in there. But they're static. If you want to move them, you move them manually. You're involved in the trade. We also have another system, a little more sophisticated, that not only puts you in those trades, but will actually play out your strategy. Move your stops, have a trailing stop with that, etc. So that's DimensionTrader.com, and I encourage everybody at the conclusion of today's program here, run over to not only to all 4 of these websites, but at Dimension Trader you can register for a guest pass into our training room, and on Monday, Tuesday, Thursdays, spend a couple hours with our moderator, who's a professional trader, and see how our system actually works in the live markets. That's DimensionTrader.com. Register for the guest pass. All right, enough about that. Let's go backwards. John, we got you right here. Talk a little bit about sector selector, how that works, and your website, and how people can come and learn more about you.
Yeah, it's wallstreetsectorselector.com. You can sign up. We have a free daily newsletter. We do a lot of webinar educational type things. We have 2 trading programs, one for standard ETFs and then one for leveraged and VIX ETFs. We're developing all of those kind of things, fleshing them out even on a greater basis. So if you're interested in ETFs, and particularly the VIX and leveraged ETFs, it's a good place to take a look and see what we're about. And there's no risk going into it. It's just a free sign up and watch what's going on.
Now, do you suggest which sectors are moving, or the better sector to be in at any given time? And are those longer term positions, or not?
We have the standard ETF program is just based on the major sectors, and those are either long or in cash, and they tend to be longer range trades. Of course, if you're doing the leverage and the VIX, it's much more short-term trading, long short type. The holding periods are much shorter because those are a little bit like options. The leverage ETFs will work against you over time with the way they're priced daily, and they compound. That compounding can work for or against you. So there are 2 separate things there depending on what the person wants.
All right, very good. And that's wallstreetsectorselector.com.
Yes.
Stephen, any closing statements here, and a little bit about your website?
InvestingWithOptions.com will teach you how to become a great options trader. My specialty is a combination of income trading, which looks to profit from non-movement in the market, and then swing trading, which looks to profit from actual movement. in the market. We do have a 2-week trial for $14 where you get access to all of my video training, my chat room, all the trade alerts, email trade alerts, and everything like that. So I think the link is investingwithoptions.com/trial, and it'll take you to the order page. I would love it if you would stop by. If it's not for you, that's fine. And if it is, then you can stay on as an IWO Premium member, and that's my spiel for today.
All right. And one of your programs I heard you mention earlier was an income program with trading options for income.
Sure. That's actually part of IWO Premium. So I've got a couple different kinds of income trades. Iron Condors, which are wider and higher risk relative to reward. I also use butterflies and calendars, which are I use a scaling approach, because one of the things with income trading is that you're going to be wrong initially anyways. There's just a Murphy's Law associated with it. So I rarely put on full size initially, and I slowly scale into a trade. I've got some results from 2014. If you followed all the trade alerts and you put 10% of your portfolio in every single trade, you'd be up 61% from 2014. So got some pretty good results with that. I've also got the swing trading side of things too.
Great, good results. Okay, investingwithoptions.com.
Thanks.
Todd.
Yes, sir. And actually, Cameron, I laughed and enjoyed what you said about your setup. You paint the bar when to go in, and paint it green when to go in, and red to go out. Correct?
That's correct.
So
no. Well, actually, red to go short, green to go long.
Okay.
White to go out.
Got it. And then you said go play tennis. I'm a golfer. Actually, I live right on a golf course. So what I prefer to see in your setup is green go long, and then maybe paint a tennis ball or a golf ball in the next bar to tell you to go in, and then go play golf or go play tennis, and then tell you when to come back to the setup. And the other thing I would say is S&P 21.1.3. So we missed it by 0.6 of an S&P point, so we'll see what happens there. But TradingAnalysis.com, I'm joking with Cameron. We take a similar approach. We trade the 4 major asset classes. We are swing traders. We like to have on anywhere from 4 to 6 positions a week. We try to hold them, if they're losers, 2 to 3 days, 4 days out, and if they're good trades, a week to 2 week. We are heavily based on intermarket analysis as well as technical analysis. We primarily trade options within the starting and stopping points for the different Elliott and Fib patterns that we look at. So a lot of times we do debit spreads. We do sell premium when we do see high implied volatility moving into what we'd anticipate to be a corrective pattern. Again, the style of analysis we do will tell us whether we want to be long or short premium. So we have members chart room. We can see all the major markets we're tracking. I post analysis through the day, and most importantly, when we move into a trade, you'll be SMS'd, and we will tell you exactly what we're doing in the trade. I trade live for my clients, real capital, and we have fun. So guys, I really appreciate the opportunity. I enjoyed speaking with all of you. Thank you very much.
Thank you.
Thank you. I thank everybody. David, do you have any closing remarks?
All right, thanks guys, great show. Just want to remind everyone watching to, if you want to view this week's report or any previous reports, just go to TimingResearch.com/reports, and be sure to fill out the survey next weekend for the next report, sometime before Sunday afternoon. And I just want to thank my guests again, Todd Gordon of TradingAnalysis.com, Stephen Place of InvestingWithOptions.com, John Nyaradi of WallStreetSectorSelector.com, and Cameron of DimensionTrader.com for taking over the hosting duties for this week.
Thank you. Enjoyed it.
So that's it. Thanks, guys.
Yeah,
Thanks,
bye-bye.
Tim.
It was fun. Bye-bye.